This lecture is on Chapter 2, Financial Statement, Tax, and the Cash Flow. Because this is the first lecture we're going to have for this class, so I'm going to skip the Section 4 on its cash flow analysis part. We concentrate on the more basic Section 1, the balance sheets, Section 2, the income statement, Section 3, how do you calculate tax. In the balance sheet section, make sure you understand the differences between book value and market value of those assets. In the income statement, make sure that you understand the difference between accounting income and the cash flow. There are two different concepts. As for the tax section, make sure that you understand the difference between average tax rate versus the marginal tax rate. Now let's start with the first section, a balance sheet. What is a balance sheet? A balance sheet is a snapshot of the firm's assets and the liabilities at a given point of time, usually the end of fiscal year. Now, the balance sheet usually divided between left panel versus right panel. On the left, the accounting statement usually lists the assets. The assets are listed in order of decreasing liquidity. So the first one usually is the cash. Then the accounts receivables, then inventory. Now those short-term assets, which means it can be converted in cash within 1 year, are called current asset. Next one will be fixed asset. In fixed asset, they have tangibles, those buildings, machines, or intangible, copyright, those intangibles, for example, of goodwill, for example, right? Now, those are the asset side. We usually put on the left. On the right-hand side, you have the liability. Now, purple color shows the liability. Within the liability, you have current liability, which like accounts payable, which means you have to pay it within 1 year with short-term liabilities. The other one, long-term liability. Those are corporate debt, for example. So those are liabilities. On the right-hand side, we also have owner's equity or shareholders' equity. Now, though, the difference between current asset and current liability are called net working capital, which is the money tied up by the operation. So a balance sheet, by definition, the left-hand side, assets, must equal to liability plus shareholders' equity, by definition. Now let's look at these three things, okay? The first one, net working capital, which by definition is current asset minus current liability. Most firms, they are positive. Think about, usually, for example, inventory is one part of it. Money tied up by inventory. And in the debt, on the right-hand side, you have liquidity for short-term one and the long-term ones. Long-term debt is vulnerable about if the financial going down, you have to pay the interest rate. You have to pay interest payment. If you cannot meet those interest payments, then you are subject to bankruptcy. right? So the difference between debt, which is obligation, equity is the ownership. You need to worry about that. Now, what is the equity part? Equity part, as a matter of fact, is the total asset, which is the left-hand side of the balance sheet, minus the total liability. Now, let's look at some examples. Here is a corporation's balance sheet as of December 31st, 2015, and 2016, usually in multiple years. All numbers are millions. Now, let's look at the asset side of this corporation. The current asset, which includes cash, accounts receivables, inventory. You add them add all three items up. The total short-term asset, we call it current asset, is 1112 million. Plus the fixed asset, for example, their buildings or machines, 1644. Add these two together, you have 2,756 million. Now let me using the pen to show this number. Now this is the value of total asset at the end of 2015. Now let's look at right-hand side. Now that number is exactly equal to the total liability and owner's equity, as the name suggested. It is a balance sheet. The left-hand side must balance the right-hand side. Any dollar here must belong to either shareholders or to bondholders. All right. Now let's look at next year, 2016. The current asset is 1403, and the net fixed asset is 1709. Add these two together, the total asset actually increased, which is 3112, which is exactly equal to that number. 3112 as the total liability and owner's equity. Obviously, the ownership also increased. Now, let's pay attention to the net working capital. Net working capital is the difference between current asset and current liability. For 2016, the current asset is 1403 million. The current liability is 389, right? So the difference is 1014. For 2015, the net working capital is 1112 minus 428 equal to 684. What that tells you is this company is growing. It's the more money tied up by its working capital. For example, they have, if you're looking at accounts receivable, their cash increased. That's a good thing. But they also, accounts receivables also increased. That means more customers are given credit, right? For the sales they generates. So this is the balance sheet. Make sure you understand how do you calculate net working capital. Now, in this in balance sheet, there is one concept is important. All the number reported in balance sheets are book values, which is type of historic cost based on, for example, the inventory, how much you paid for it, right? Balance sheet. However, Market value, how much those assets really worth, which is the market value, represents the current value. The book called it true value. Is the price at which the asset, liability, or even equity actually can be sold and bought. Right? This is the market value. So it's quite different. So market value and book value are two different concepts. The reason is the book value is based on historic cost, but market condition is constantly changing. So every day you have more information coming in. So which is more important for the decision-making manager? What the value you need to know. For example, if you want to buy a company, is the company book value important? Yes, obviously. But how about its market value? Actually, market value is more relevant because this is the price you will pay. So make sure that you understand market value versus book value. Now let's look at one example. In the example of textbook 2.2, Klingon Corporation is balance sheet. Now, on its asset side, it has a current asset. When they purchase, think about its inventory. When they purchase, it's $400. The fixed asset, according to historic cost, is $700. So the book value is $1,100. Now, if we know the current value of its inventory or its current asset actually increased, it's $600. And the current asset, their buildings, their machine, is equal to $1,000. So the market value, if we know, actually is $1,600. In other words, $500 higher than the book value. Let's take a look at the right-hand side of the balance sheet items. In the book value, as the balance sheet showed you, the corporation has a long-term debt of $500. So the total asset value is $1,100 minus $500. You get $600. The $600 is the asset value. Is the shareholders' equity value. Now, this is the book value shows. How about what the market value is? Particularly, you want to know what is the shareholders' equities are now, book value. We find out, go that way. I'm going to move this one to the next slides. Next slides. That is the same thing, okay? The same thing. So how do I determine the shareholders' equity? As a matter of fact, first, you move the book value, which is a long-term debt. That's assuming they have same value. You still owe people $500. The market value is still $500. But if we already know the book value, the market value for the asset now is $1,600. So what is this value for? What is the market value for shareholders' equity, which is $1,100? How do we find out? It's use the total market value of the company minus its liability, what's left, all belong to shareholders. Now, this is when, in most cases, when economies grow, economic conditions good. This is what the people are looking at, right? When the value increased, as long as you paid off your debt, all the increased value will go to shareholders. To understand, shareholders is getting residual value. or whatever the market value is. Now, let me give you one unpleasant situation. Let's assuming the economy next year is pretty bad. Now, what I ended with, for example, everything is shrinking. The current asset value, let's think about inventory, instead of 400, now the value goes down, go to 300. On the book, the building or the machine was 700. Now, because the market kind of crashed, all the value, all those assets losing its value. Now, current market value is 100. So total market value now, instead of increase, it decreases from 1100 to 400. Now, how do we find out the market value for shareholders' equity? We do the same thing as we did earlier. First, we write the debt obligation. So the company owns $500. We still own this liability, $500. Now let's look at what is the market value the total asset will be. Now, in this situation, it's 400. Why? Because this is the market value. I'm telling you, the whole thing actually shrinking. The business is shrinking. Think of buy a house. Housing loses its value. Now, as a balance sheet, what's the value for shareholders' equity? We're using 400 minus 500. It's negative 100. Now, in that case, negative equity in the situation, I'm thinking about housing value, the housing value of dropped below the mortgage loan amount. Now, in real world, sometimes people just walk away. It's a limit liability, so they quit. The bankruptcy, declare bankruptcy, right? Because it's negative. This one just show you shareholders' equity is very risky. If economy doing well, as long as you pay off the debt, you gain handsomely. But on the other hand, if the economy goes down, the asset value goes down, then your investment might be in jeopardy. Here it showed you in this situation, a negative equity situation, right? So it usually leads to a bankruptcy. Now, please fill out this one when you have time. Just help you to understand how you figure out the shareholders' equity, which is the market value minus market value of the debt obligation, which is shareholders' equity. Okay? The second financial statement is income statement. The income statement measures performance over a specific period of time. So if we say balance sheet is a snapshot of a corporation's asset and ownership, an income statement is kind of like a video. You're looking at one fiscal year, if we're talking about fiscal years, or quarterly or monthly, is what the cash flow will be. Now, first, usually we report revenue or sales. So we say the income statement, we start at the top of the line, usually the sales or gross revenue. Then you basically deduct all the expenses. So it's ended with an item called a net income, which is also called bottom line. It's bottom line. Bottom line is the last items on a income statement. But the bottom line, the income statement, if it's positive, you also will be paid. How do you distribute those net income? Will be either go to dividend, paid to the shareholders, or you add back to the company retained earnings. Retained earnings. An income statement, the equation pretty simple, which is equal to revenue minus expenses equal to net income. Let's look at one example. A corporation, also in millions. The sales is 1509. Cost of goods sold. Now that's negative number. You deduct this part. Now the third item's depreciation, which lets you write off the initial investment, which will reduce your tax liability. So net sales minus cost of goods sold minus depreciation, then you have EBIT. Earnings before interest and the tax. The first line of that, the company's profitability, is EBIT positive. So it's earnings. Now, with that earnings, you paid interest first. Because you paid interest, then this one, so 694 minus 70, you get a 620, which is a taxable income. In that case, you have paid corporate tax. Let's depend on what the tax rate is. Times that tax rate, the tax amount is 212, and 412 is the bottom line, net income. The bottom line, usually people put a 2 line on it. So, remember, this is a minus, okay? 620, this is the tax. You get a bottom line. Within the bottom line, you pay 103 as a dividend. 412 minus 103, 309, you go to retained earnings. You're basically going back to put the cash back into the company's operation. In financial statement, we're using generally accepted accounting principle, matching principle here. They basically said recognized revenue will be recognized when it is fully earned. So we're using matching principle to match expenses to generate those revenues. Pay attention to the non-cash flow items like depreciation. Depreciation, nobody really write a depreciation a check. The purpose is to reduce your taxable income. It's a part of using the matching principle. It lets you match expenses versus each year's revenue. So let's pay attention to that one because when you study company corporation, you find the bottom line net income. You add the depreciation back, which represents operating cash flow. It represents cash flows. You add it back. Because the purpose of depreciation is to reduce your taxable income. Now let's look at a few real examples. The book using the SEC publication, Edgar, but I'm like using the website called finance.yahoo.com. You can use that site to get those financial statements for those public traded companies. Let me just show you an example. You click that, or you key in finance.yahoo.com. You go to Yahoo Finance. It's a homepage. So here, let's look at one company. It'll give you all those financial informations. I want to look at Netflix. So I key in F T F L. Netflix. NFLX. I'm looking at Netflix. Okay. Let's look at Netflix. So here's the information. Currently traded at 256. Increase a little bit. Now let's look at the tab here. Summary, chart, statistics, historic data, profile, financials. Let's click financials. In financials, they provide three financial standard financial statement. One is the balance sheet. Now, we are looking at its annual balance sheet. One is income statement. The other one is cash flow statement. Now, first, let's look at the balance sheet. We're looking at the annual one. Here, they are listed 4 years from 2014 up to 2017. This year is probably, they haven't come up with this year's yet. So you have current asset, total current asset. Then you have all those fixed asset. You add them, total current asset with all those fixed asset part. You have total asset here. Total asset here. Now let's look at this one. Netflix. You'll find Netflix, the current asset are increased. Right? 2014 to 2015, there is a big jump there. The company is doing well, and total asset also increased. It's almost, tripled for the 4 years, from 7 to here 19, 20, close to 20. So it's increased. And current liability and shareholders' equity. Well, now in shareholders' equity, there is a retained earning, I think. Retained earning. Retained earning is a positively increased. It means they put a lot of money back into the operation. The profit reinvest in the company. Retained earnings. And the total stock equity. So if you add the total liability to the total stockholder equity, it must equal to the total asset. This is the balance sheet, left-hand side. Yes. For this reporting, they tell you they are not really summarized on the right-hand side. Here is up portion and low portion. They tell you a word called a net tangible asset. There is some accounting people like looking at only tangible. They want to ignore the intangible. Those are kind of old traditional way to do it. For a lot of high-tech company, they have a lot of intangible assets like copyright. So those things, or some kind of special right in Netflix now is a production function. Think about some licensing, etc. So, but you can verify that you add the current total liability with the owner's equity here 2679. It must equal to that total asset number by definition is the balance sheet. So here showed us it's doing well. Why? Because the total asset is growing. Netflix is growing as far as the 4 years, during that for the 4 years. Next one you can look at it is the income statement. And income statement, we're also looking at the annualized 4 years. Income statement, particularly, you can look at is the net income. Net income here. The net income are positive means they are making profit. They are making money. And the profit, as a matter of fact, in 2017 is quite well, net income high. For 2015 and 16 is lower. We will study those profit margin later, right? But just this one to show you how during that year, how the company doing. From this information, we'll see the bottom line of Netflix actually is growing. The third income statement, a third financial statement, is called a cash flow statement. It's really dealing with cash flow because net income is not cash. Now, the cash flow statement is pay attention to the cash. It's a little bit more complicated. For the time being, for this financial management class, I don't want you to spend too much time on that. Okay, so let's go back to our lecture notes. Where's my lecture notes here? No. Okay. You can go to Financial Yahoo and looking at all the company information, those public traded company information. Next week we'll do some financial analysis. You're looking at how is the company doing. Okay. Let's move on. Now let's talking about tax. In corporate tax, there are two different. One is called a marginal tax. The other one called the average tax. Now, how do you calculate the tax liability? Now, the marginal tax is a percentage tax you pay for next dollar. Now, the corporate tax system, like a personal tax system, is progressive. Not every dollar will pay at the same rate. So we are going to ask you to do the calculation. Here is one corporate tax rate. Now, before this year's tax reform, what the tax reform really is, I'm not sure yet. This is obviously the old one, but it's a very, very typical. Here is a corporate tax table. Now, for every dollar between 0 and 50, you pay 15% corporate tax. Above $50,000, from 50,001 to 75. Now this, you pay 25. This range. Now how much the range is $25,000? 75,000 minus 50,000. The incremental $25,000, you pay a little bit higher, 25. From 75 to 100, you pay 34, pay a little bit more. From 100 to 335, you pay 39. This is the highest one. Then from 335 to 10 million, then you pay 34. Now those are what we call marginal tax or progressive tax. Let's assuming that your company earned 4 million taxable income after you write off your depreciation, paid off your interest. You have 4 million, which is subject to income tax. What is the company's tax liability then? How much they want to pay? And what is the average tax rate the company has? Also, the question, what is the marginal tax the company are facing? Now, nowadays people are like using the TurboTax. Sometimes you don't really looking at the table to do it. But as business major, I want everyone to work on this problem. You need to know how to do it. The best way to do this one is use a spreadsheet. Like Excel, the spreadsheet. This one, as a matter of fact, is a spreadsheet. First, let me just, you can click this icon. Okay, let me see. Should I using Shift, click, or using Option click. Okay, it's a spreadsheet. Now here is the corporate tax table. From 0 to 50, pay 15%. So this is what the table is. The company tax liability is $4 million. So you paid something below this line, 1, 2, 3, 4, 5, along somewhere here. Because 4 million is below 10 million, above this. So you are somewhere here. So this you are dealing with 1, 2, 3, 4, 5. You're dealing with 5 bracket of tax rate. How do you calculate? Here is how do you calculate. First one, using 50,000. Oh, sorry. Nope. 50,000. Here's $50,000. Is 50,000 minus 0. You pay 15%. 50,000 times 15%. The tax liability is 7,500. Next is 75,000 minus 50,000. You get 25,000 is the taxable income. This amount, you pay 25%, which is 6,250. Next is 100,000 minus 75,000. You have 25,000. Next 25,000, you pay slightly higher, 34%, which is 8,500. Next, 335 minus 100, you get 235,000 times 39, which is higher. You pay 91,650. Now, be careful of this one. You are not using 10,000 because you don't have 10 million. You only have 4 million. So what you calculate is 4 million minus 335,000. You get 365,000. Yeah, using that number times 34, you get this. Now, those, you see, those are income, taxable income, total amount 4 million, right? Now, here is the tax you pay on each bracket. Add them together. The total tax liability for the company is 1,360,000. Okay. Now, how do I calculate the average tax rate here? So this 34%, the equation is using this 1,360 divided by 4 million. You get a 34. The question asks you, what is the marginal tax rate? Marginal tax is the last tax rate you paid. In other words, the corporation currently is 4 million. Anything more than 4 million, the last one is 40. You pay 34%. 34%. So the average tax rate is the total tax you paid over the taxable income. Okay? The marginal tax rate is the last dollar you paid. The last dollar you paid. Yeah, if you have a chance to look at a spreadsheet, I don't know how to open this one up. Let me see. Sometimes if you open this up, you can follow the. It's a kind of a slower for my machine to open. You click this icon. They show you how do you do the calculation. You can use your. No, here it is. Here it is. Here's a spreadsheet calculation. Spreadsheet calculation. Now, it's kind of tiny. Can I make it larger here? Yes. All right. So this portion are the tax tables. This portion, how do you calculate? For example, if I'm going to click the D5, this one, how do I calculate? The formula says, let's look at this, the formula part. B5 minus B4. In other words, you say the B5 minus equals something is a formula. Minus this sign, you get a 25,000. So you can look at the B5,000. Here is the formula. Now, how do I get this 6.2? Is the D5 is this taxable income times 25% interest rate. Now, these are the input are given. Those are the calculation, right? Now, 34%, the average tax is looking at. Now, you can use, go to data, looking at, I'm sorry, not data, go to formula, not formula. You can look looking at the detail to trace how those formulas are done. So this one, if I highlight this, is E12 divided by D12. E12 is the total tax you paid, which you add them up. Divide by this, you get 34. And how about what the marginal tax is? Marginal tax equal to C8. C8 is, this is your last bracket of the tax rate. Please, working with this spreadsheet, make sure you understand how do you calculate the corporate tax rate. Okay, well, you will do this. You will ask to do this in your midterm. Here, let me go back to our lecture now. So the tax rate, you calculate your tax rate. Here is the reported average tax rate, the corporation tax people usually paid. It depends on, obviously, taxable incomes, right? Those are after depreciation, after interest payment. 45, the marginal tax is 15. As the corporation going up. Now, did you say that? You said that, oh, the tax rate is progressive because as you have more money, you pay more. But after 2,500, 250,000, the rate from 39% dropped to 34%. What happens? Oh, those, I know. The corporation lobby group do all those, exceptions, the tax rate. This is make tax very complicated. So it's not really strictly progressive because here this amount is pay most amount. The average tax rate, obviously, is not the last marginal tax rate because the early dollar you pay the less. So the marginal tax rate usually is lower. It also depends on industry. For example, if the cash flow is really stable, those old traditional industry like utility company, trucking company, railroad, right? Those company, the average tax rate is usually higher, but the utility company pay a huge amount of tax rate, almost 34%, right? On the other hand, biotech company, internet, those are tax rates relatively lower. The government basically encouraging those, new technology to give you a tax break on that. So, the tax rate. All right. Early when I show you the Netflix financial statement, I said there are three financial statements. One is balance sheet, one is income statement, the other one is cash flow. This book's cash flow is slightly different than the traditional cash flow statement. This is why I want to skip it. But we do need to know a concept. What is cash flow really is? Cash flow really is an important concept. It's one of the most important pieces of information you can derive from the financial statement. It's not directly reported sometimes. You have to derive. So accounting statement cash flow, as reported like online, is using different information set as the cash flow this textbook talking about, which is what we call free cash flow analysis. Because the time limitation, for that reason, I decided to skip that section. I don't want to confuse you, particularly for those who did not have the prerequisite of financial accounting. So you will be totally confused. But as long as you remember that revenue or accounting net income is not equal to cash flow. It's not equal to cash flow. So you need to figure out what the cash flow is. This is a relatively short lecture. I just want to show you how do you can using my narrative to help you to understand, go through with those lecture notes. At the end of lecture notes, you don't have to go all the way. Always using the pause. You can always stop somewhere. You don't need it's pretty long sometimes. The lecture notes can be very long. You can either using pause or using the subject index. I'm going to provide some subject index. You can go to, for example, you want to look at tax, which is starting from 30 seconds, 20 minutes. Go to 20 minutes, see what the tax rate is. Okay, just look at those index. So you look at the piece and piece. At the end of those lecture, there are certain good reviews help you to understand. For example, in this lecture, they say that what is the difference between book value and the market value? Now you can click. You try to answer this question by yourself. Do you understand? You answer, or they give you give you a clue. You click the slide, it go back to. They show you what the book value, what the market value. Obviously, market value is more relevant, more important for decision making, not the book value, right? Then you can go back. By the way, because I add some of my material in it, so those page number or the slide number might not exactly what the original, the publisher's number are. Slide 2.8 might be not 2.8 anymore. So, but this is to give you a clue. It helps you to summarize what your the lecture will be, how to help you to understand the key concepts. All right. I hope you are enjoy the this lecture. I hope it's not too complicated. After all, you have to read the textbook, and more importantly, is do the homework. You have to keep up with the progress of the lecture. Do it constantly every week, every Thursday, Friday. Get some number. Okay, and particularly the homework. When you turn in your homework, which I is carefully chosen from the end of chapter problems, the key concept, you work on it, do your best, and you turn it in. I will grade it. I'll also give you feedback. When you get your feedback, look at what the mistake you make. Then you learn through those, correct those mistakes. So the end of this lecture, let me remind you, please keep up with the progress as the syllabus suggested. Every week, do the things on time. And also pay close attention to the homework you need to turn in. I will give you one-on-one tutorial on that because I grade your homework. The mistake you're making, I will point it out. You need to learn through those process. All right. So far, So good. I'll see you next time. Bye.